Good evening, traders and investors. Will back here with another one, coming to you with a Thursday market recap. Hopefully, you guys had a very good day today. And in today's markets, guys, well, the SPY and the QQQ ending higher. But as it has been the case many times over the course of the last 2-3 months, it was another headline-driven day. Number one, we know that the markets have been getting somewhat impatient for a trade deal. And today, we did get the framework to one. In the early hours of the session, we know that we were waiting for a big announcement from the Trump administration, and that had to do with a deal between the United States and the UK. Trump saying a trade deal with the UK is close, but that a 10% tariff remains on some items. Now, this deal was broadcast from the White House for a telephone call between President Trump and the Prime Minister of the UK, Keir Starmer, in which several items of a deal were mentioned, but no actual deal was formally signed or written. So we do have a framework in place, but no actual formal deal. Now that led the markets to have a very nice early morning sessions. They responded very well to it. And then we were kind of holding flat throughout the rest of the day. And towards the end of the day, we got one last piece of news, which led to a bit of downside. And that was this one: Trump considering a tax hike on Americans making $2.5 million or more per year. Those are the major two headlines of the day. And we're going to cover them very briefly in just a few minutes in today's video. Speaking of today's video, we have a few items to cover. Number one, we'll be going over those two pieces of news and my impressions on them. Number two, we're going to be going over 3 company earnings that I have prepared for you guys today. We're going to be covering Shopify, TradeDesk, and Cloudflare. Now, special shout out to all the other companies reporting today, but because we have limited time, I'll be covering those 3, since those 3 are the ones arguably that have moved somewhat the most after their earnings releases. So after that, we're going to take a look at our major technical analysis rundown in terms of our major market indexes, followed, of course, by our usual rundown of our big tech names, see if there's any deals still to be had across all the big tech names on that list. And lastly, well, no portfolio update for today. That will be reserved for the Friday session as per usual on the channel. I do one big one on the Monday and then another big one on the Friday session. So it should be a very fun video today, guys. Let's jump right into the action, shall we? So SPY up 0.7%, the QQQ's up 1.03% overall, and it was a fairly broad-based day of rally in the markets. Big tech having a pretty good day, the banks having a pretty good day, but once again, healthcare being a pain point in the market. This has been your lead bear in terms of recent trading weeks. For the last 2-3 weeks, healthcare has done a whole bunch of nothing as pharmaceutical companies have come under the gun for some, sectoral tariffs overall. And even one of your largest health insurance providers, UNH, has just not been doing a very good job of holding up that segment of the market there. Consumer defensives were a bit weak today as most of the money did rotate into some of your more growth-oriented plays. And the bottom half of the market, I would say, was mixed. Industrials had a good day, but real estate and utilities, not so much. Shout out to energy and basic materials. Now moving on to the one-day relative, you can see that even better to where most of the market was in the green, but we did have some red points there. Industrials, cyclicals, energy, and technology to the upside, and to the downside, real estate, defensives, utilities, and healthcare. Your more defensive sectors of the market were pulling back in favor of some of your more consumer-oriented and growth-oriented segments of the market, possibly because people are trying to establish a little bit of bullish positioning leading into maybe potentially more trade deals on the near-term horizon. Where do we stand on the 1-week relative, guys? Well, all segments of the market have been in the green, everyone except for healthcare, of course, which has been really lagging behind the entire portion of the market, but that does not last forever, right? We know that some sectors play the leading game, some play the lagging game, and it's just a whole game of rotation. Technically speaking, you should be looking, if you want to find the best deals, for some of the sectors that have been lagging behind recently, and that has definitely been healthcare. So before we get into more technical analysis, guys, let us dive into those elements of news that came out today. And of course, we're going to start off with the big one, which is the trade deal. So the trade deal with the UK is close, but a 10% tariff remains on some items. Quick little reminder, guys, the tariff rate after the reciprocal tariffs were announced on the United Kingdom in the middle of the board right here was supposed to be 10%. And that 10%, as a matter of fact, is maintained. Now, what was discussed on the phone call this morning were several different items surrounding the trade deal, the framework of the deal that was going to be had with the US and the UK, and it's as follows. The agreement will see duties on UK car imports reduced from 27.5 to 10%, which I'll remind you is the baseline minimum. And also, tariffs on UK steel imports will be dropped. Now, we don't have a lot of imports from the UK in terms of steel, but a welcome little factor right there. In return, the UK is lowering trade barriers on US beef imports and ethanol. So I'll also remind you guys over here that the United States actually runs a trade surplus with the UK, which unfortunately my big head is in the way of. Let me just move myself over. You can see that the UK is one of several countries that we do have you guys rather, because I'm in Canada, have a trade surplus with overall of about $4.6 billion per year as of 2024. So that was the framework for the deal overall, guys. Can't really say too much more in terms of everything other than the fact that several people were commenting, especially JP Morgan, that added that it was unlikely that US tariffs on British goods would be eliminated entirely and could be set at the 10% baseline Trump has imposed on all other countries. So essentially what we're trying to say here is that the deal moved from 10% just back to 10%. So not much advancement on the entire effective rate, but we do have several different items, which we discussed prior, which are being renegotiated. Now, the biggest takeaway from this entire event is most likely political positioning, that the United States is ready to negotiate so long as the terms are being met. Now, of course, we always knew that, but this does set the stage for many more countries to possibly come forward and put some offers on the table and to renegotiate those deals moving forward. So nice to see one finally get underway. Of course, we'll keep track of these deals in the pipeline on the channel moving forward. Now, piece of news number 2 had to do with that tax hike, of course, whereby the Trump administration was considering a hike on Americans making $2.5 million or more per year. So essentially taxing the wealthiest cohort, which is something that both sides of the political aisle have been asking for a very long time. Could we maybe see a reduction towards the lower income brackets in favor of taxing the higher income brackets? Maybe that might be part of the plan moving down the line. So Trump is considering allowing the rate on individuals making 2.5 million or more to increase by 2.6%. So not a very large increase, but when it's on that many dollars, definitely it does have an impact. That goes from 37% effective to 39.6% effective tax rate overall. Those are your 2 large pieces of news that did contribute to moving the market either way. As I'll remind you guys, in terms of the Trump policies, we always have to look at them in a totalitarian standpoint, right? In terms, or rather a total standpoint, a totalitarian rather, that's a political term. So we have to look at number 1, of course, the trade policy. So all the tariffs. Number 2 is going to be the tax policies, either on corporations or individuals. And number 3 that we have to always pay special attention to is the deregulation. As we saw some news yesterday in terms of semiconductors looking to kind of deregulate some of the regulations that were put in place by the prior Biden administration to quote Jensen Huang, let the chips flow freely, essentially, and establish technological dominance across the entire rest of the globe. So that is everything for your news headlines. Now that we're through that, let us dive right into our corporate earnings, and we're going to start it off with a pretty good one. We're going to start it off with Shopify, as a matter of fact. Sorry, I was going to do TradeDesk, but Shopify right here. So Shopify initially, after their earnings that came out this morning, was down initially 7%. But they were able to retrace most of those gains and end of the day almost flat. Let's get into some of their numbers, shall we? So in terms of Shopify numbers, they were not bad objectively speaking. 2.13% miss on EPS, a very small miss on those non-GAAP earnings. And then we also had a nice tiny little beat on revenue overall. Now, I'll remind you, Shopify has been a company that's been front and center in everybody's attention over the last 3 years, as they lost a ton of shareholder value in 2022, going down over 83% from the top to the bottom. All the focus was going to be on, is the business still expanding? Are they still expanding gross operating and net margins overall? And are they having still very good customer retention? And the answer to all 3 of those questions is indeed yes. So let's have some of the looks at the article for Shopify real quick, shall we? So in terms of Shopify stock slips on light guidance, and the company notes tariff uncertainty. Let's have a look at exactly what that means. So they posted mixed first quarter results and issued soft guidance for the current period. As I showed you, they beat on revenue, but they missed on EPS. Moving overall, for the second quarter, here's the guidance. Shopify said it expects gross profit to grow at a high teens percentage rate, while analysts had forecast a rate of 20.1%. So missing on the guidance. That's what it means by soft guidance, missing, unfortunately, the gross profit margin metric. The company expects revenue to expand at a mid-20s% rate compared with a year earlier. Wall Street had forecast roughly 22% growth. So beat on company revenue, but a miss on margins. And that's always been one of the pain points for Shopify, is that their margins are just so inconsistent. As you can see from the chart on the bottom right-hand side there, on a year-to-year basis, guys, the margins are just not consistent. Some quarters they come in under the estimate. Some quarters they have very high net margins overall. But the consistency has always been a problem for this company. I'll remind you, Shopify has gross margins almost around that 50% mark. Operating margins have been moving higher towards the 20% mark, and net margins, how much money they bring to the bottom line, has been somewhat of an oscillating factor over time. That is one of the problems with the company's consistency. Many of Shopify's merchants are small to medium-sized businesses, giving it some exposure to President Donald Trump's sweeping tariffs on Chinese imports. But how much? Well, at least the CEO said something. As part of the Trump's tariffs, the president last week closed a trade loophole favorable to many online businesses that allowed shipments for China under $800 to enter the US duty-free. That is otherwise known as the de minimis exemption, which a lot of companies from China were benefiting from, such as Temu and Shein. That loophole was since closed. How much does it affect Shopify, though? Well, here's what the CFO had to say. The expiration day of de minimis isn't expected to have a meaningful impact on Shopify in the near term. Roughly 1% of its gross merchandise volume is related to imports from China that were subject to the exemption. So a very small percentage of GMV is actually associated with that. So in other words, the CFO kind of dismissing any uncertainty factors around those tariffs, right? The company hasn't seen broad-based price increases either among sellers yet. He added that consumers who purchase from Shopify businesses skew higher income, with more than half of buyers in the US having incomes above $100,000. So a few things that the CFO was saying there, saying that, maybe Shopify might be better insulated than other e-commerce brands to weather a potential economic downturn storm. Now, here's what he had to say as well. We acknowledge the uncertainty ahead and are actively monitoring our data to help us support our merchants and adapt to whatever changes may arise. Moving on further, Shopify's GMV, a key metric that measures the total volume of goods sold on the platform, was $74.75 billion during the quarter, and that did fall just short of the consensus estimates by 74.8, right? Of 74.8 rather. So very short. So as you can see, missed on a few key metrics here for the quarter, and the guidance was somewhat soft. However, revenue for the quarter was up 27% year over year. Shopify has always been able to grow revenue in excess of 20% in year over year comparisons, at least for the last 3, 4, 5, 6 years plus, right? That's never been a problem for them. It's always been a question of, can they bring more of that money to the bottom line in a more efficient manner? This quarter, because of one-line items, they lost $682 million. Last quarter, they were profitable, but every single quarter, there seems to be one thing in terms of net charge-offs or one-time line items that keeps them from being a consistently profitable company. And this quarter was no different, locking in a loss of $682 million. Now let's take a look as well at some of the metrics for the company. As we can see right here, revenue by category was pretty good. Subscription solutions revenue and merchant solutions revenue have always been growing in tandem, higher and higher every single quarter overall. Now Q4, as we can see many times on this chart, is the best quarter of the year for Shopify. So what you're looking for is year-over-year comparisons from Q1 to Q1, and this one was definitely a banger, with both of those metrics coming in wildly higher than they were. So the company is still growing both of its lines of business very, very well. Let's take a look at some of the earnings slides real quick as well. We will see that Shopify does a very good job of putting together a pretty good presentation for us here. So here we can see the 27% bump on revenue overall, 1.2 trillion in global e-commerce since Shopify has actually launched its platform overall. And we now have 875 plus unique online shoppers that were purchasing from Shopify all throughout 2024. Very good. They have 12% US e-commerce market penetration and market share, and it does appear that they are growing that, so what the company says, and are looking to expand even more. And they cater to millions of merchants in 175 plus countries. It's a very solid company, guys. I play this one on and off, but it might just be time for me to also start a long-term position now that the company is moving in a better direction overall. A few quarters ago, they cut their non-profitable logistics business when they understood It's pretty hard to have a logistics business, right? It's very low margins overall. So rather than doing last mile delivery for their customers, well, now they're just being an e-commerce platform. I was happy with that decision a few quarters ago, and now it just might be time for me to revisit that stock a little bit for a longer term position. Now, here are some of their clients overall. You can see some very, very big names here. A division of Nike is there, Kith Brands as well, Gymshark, a very large company, and even a company like Mr. Beast. Mr. Beast actually hosts his website on and through Shopify, which is pretty good. And you can see some other fairly large brands overall right there. Now, if we move down in terms of the slides for what we're actually looking for numerical data here, Shopify Pay is a very large component of their platform as well. So of course, what they do is they allow people to build websites, or the company can even build a website for you if you're a large enough brand, I assume. And then you can funnel customers towards your products and use Shopify's platform as a checkout service. Now, when you check out, you can either pay with a few different ways. You can either pay with Shopify Pay or PayPal or just other payment methods. And they've been really pushing hard for Shopify Pay. Cumulative gross merchandise volume put through there is about $225 billion since the launch in 2017. Very good. In terms of 2024 overall, that was a $75 billion increase overall. So looking quite good in Q1, $22 billion, which is a 57% increase year over year. Very good. They excel at building a global ecosystem. App and channel partners includes most of everybody. So that is exactly what you want to see. And the product partners, you can see several buy now, pay later platforms or other payment processors. They really cater to the biggest and the best of the bunch overall. Our revenue cohorts get stronger over time. This is talking about their clients. How is their Q1 2015 cohort growing? That cohort has grown at a 12% compound annual growth rate. So people that started a brand on Shopify all the way back there have been able to see some fairly good growth on the platform ever since. And that pattern persists across all of the cohorts. You can see all throughout the years, they keep track of their customers, and everybody is moving steady up and to the right, as Shopify does offer a very good platform in terms of that. Now, moving on forward, they say that the core market of e-commerce still has so much runway right there. They're penetrating in every single market. North America is their strongest penetration at 16%, but you can see that the other markets, Asia Pacific, Latin America, and EMEA, are also all moving higher up and to the right. So apparently, the total addressable market still remains quite high for Shopify overall. Now, moving on a bit further, talking about that penetration, only 2% penetration of our opportunity in the geographies that we currently serve. Apparently, the total addressable market is $850 billion of global revenue from e-commerce overall. And of course, online payments, they're including that as well. So very large total addressable market. Will they be able to compete with other brands? You know, they compete with other brands in several different segments, of course, but mainly Amazon for the e-commerce division overall. Helping our merchants grow their business drives our business. They're taking share, 20% or greater gross merchandise volume and revenue growth in the past few years. Here's your merchant solutions businesses. And then on the green bar down here, we have the merchant solutions overall. So looking very, very, very solid in terms of Shopify's growth. The Shopify payment penetration continues to increase over time. 62% of all people who are now checking out essentially on Shopify are using Shopify Pay. That is very strong, guys. Extremely strong since launching the service here in 2020. Well, essentially, this is what payment processor does the merchant utilize, right? Because when you're a merchant, you got a bunch of customer sales coming through from many different areas. What percentage of that, right? You can either use Stripe, you can use you can receive your payments through PayPal and stuff like that, right? But 62% of all merchants are choosing to use Shopify payments to get the money from the clients through the payment network into their own bank accounts thereafter. And of course, that generates some very juicy fees for Shopify. So nice to see that. Monthly recurring revenue continues to grow. This is from people who obviously have a subscription service with Shopify in terms of running a website. So looking very good there. All in all though, guys, very good. Gross profit margins though, down from 2020 and 2021. They are upticking a little bit. And the free cash flow, as you can see as well, is having a nice little uptick overall. All in all, guys, they're doing good. They're reducing their cost features as well. Lowest quarterly operating expenses as a percentage of revenue at the end of 2024. You can see they've been making leaps and bounds in terms of bringing their operating expenses as a percentage of revenue down from the 40s to 50% range back here in 2023 to now all the way down to 36 to 32. So as the business scales, they are able to drive more operating efficiency, which is what you are looking for in a company. Remains to be seen if they can be consistent on that bottom line, though. And that is pretty much everything that I want to cover you for those slides. I mean, we can go through tons more. There's tons of more slides overall, right? Subscription revenue continues to increase year over year. You can see that through different cohorts, right? Standard, Shopify Plus, and then their revenue through their apps and stuff like that. So many different metrics, right? But the one thing, the one thing that you have to keep an eye out is their operating margins and their bottom line net margins at overall. Of course, here they bring several slides at the end of the presentation focusing on the fact that, you know, the sales and marketing portion of the business is trying to become a lesser portion of revenue. Research and development, now they're spending tremendously less on R&D, which is what you want to see. G&A as well, cutting back on the G&A expenses over the last 2 years from 7 to 4%. And transaction and loan losses, that stays relatively stable. But you can see they are trying their best to become more efficient with their cost structure. That is exactly what I want to see as a potential investor. This is the one thing that's kept me away from the platform for a while in terms of being an investor. But now that I do see that they're making leaps and bounds, and this is definitely leaps and bounds, guys, 15%, right? Reduction here in expenses as a percentage of revenue is very strong. So that is why I might be keen on revisiting the company overall for a potential buy. Moving on to the financial segment here, and then we're done. Financials. So financials here. In terms of free cash flow, not that bad in terms of free cash flow per year. It has been on a net increase over the past few quarters, and we can see that they do not have that much debt. So the balance sheet is definitely very good. In terms of their forecast here, we can see that forecast EPS is finally ramping in a very nice exponential fashion up and to the right after being somewhat awkward here throughout the last 5 years. And revenue continues to be the biggest driver for the company. No problem there. We'll be growing in the double-digit range, almost around a 20% yearly rate all the way through the end of 2027, so looking very good. So at $93, is this company a buy? Well, they're currently sitting at a 63 forward price to earnings multiple, which is quite high, but then again, they are growing EPS very fast as well. That gives them a 2.22 peg. Not that bad for a company growing at this clip right there. Forward price to sales at 93 is about an 11, which is somewhat high, but you can kind of give that to a technology company. That's in or around what most companies trade at. You know, it can expand in terms of the multiple a little bit here, but that is pretty fair in terms of that. And the free cash flow yield is, well, it's not 1.5%. It's not rising, but it's just staying put at about roughly about 1.5%. So not the worst in terms of free cash flow yield, but they still have a very long way to go in terms of expanding that. So the company does have some very good expansion moving into the future. If you just want to take a constant price to sales on this at around 11 and then project out into the future, let's say you take these 2028 sales figures here at roughly, let's just call it 19 billion, right? So at 19 billion by 2028, 19 times an identical price to sales, if it's always allowed to trade at 11, which it has been for the most part recently, that's like the top end of its range, you get a market cap of about 209 billion. So that the market cap right now is about 120, right? So, you know, 209 divided by 120, you're looking at an appreciation of about 74%, which would put the company all the way right back up to the all-time high sometime between now and 2028. It can happen faster, but that would be a byproduct of multiple expansion, but that would be the growth rate that you'd be looking for over the next few years. So Shopify, there is some juice left in this one. It's just all a question of how fast you're actually going to get it. If you ask me for my best buying area, guys, it'd probably be between 80 and 60 bucks. If anything happens to these markets or the economy over the next few quarters, and I can find Shopify down here, it might be worth a little bit of a heavier buy, but I wouldn't be opposed to starting a position in the mid-90s if my thesis is holding for the next 5-10 years as this company grows into more and more market share. That's everything I had for you guys for Shopify. Hopefully you enjoyed that. We spent a bit more time on it because I haven't really done a deep dive on Shopify in a long time, and I just wanted to focus your guys' attention on really what matters the most for this company is the fact that they're getting better at the operating margins. Gross margins are constant, and that should be bringing in more consistent income to the bottom line, which will please investors at the end of the day. Now, company number 2 we're going to be taking a look at is going to be TradeDesk. So I'll remind you what happened with TradeDesk last quarter when they had this disaster, which saw the stock sell off after last quarterly's earnings, a total top to bottom after that before the end of the damage was done, 60% why did that happen? Well, what TradeDesk did at that time is for the past couple of quarters leading up to there, they were touting their new ad platform, which was called Kokai. It was supposed to be an ad platform that was better in terms of utilization of AI, a more efficient platform, a faster platform, and they were migrating. It was a very big migration from their previous ad tech platform to the new ad tech platform, and that was supposed to be done by last quarter. Unfortunately, last quarter on the call, the CEO said, yeah, sorry about that. The migration is not fully done, and we haven't really fully optimized it for it either. And that was somewhat misleading. It led to some lawsuits because the CEO had been saying in the quarters prior that they had been rolling out the platform and it was being optimized. So when he said that, unfortunately, that kind of wasn't true. It's a little bit of a gray zone there. The stock just sold off. I mean, the numbers last quarter weren't that bad, but people wanted to see the pivot here. And a lot of investors and analysts were scared that that might scare clients off the platform. But all in all, this quarter was supposed to be the redemption quarter for TradeDesk, where the CEO acknowledged his misstep last quarter and said they will do everything to rectify the situation and roll out the new ad tech platform Kokai in a speedy and efficient manner, which they did. It was a prove it to me quarter for TradeDesk, and they did not disappoint. Take a look at their numbers right here. 32% beat on the EPS expectation and a nice 7% bump on revenue. Now that led TradeDesk in the after hours to not only be up, well, today they were already up 6%, and now you can see in the after hours, they're up an additional 6%, or excuse me, those are not the after hours, that's the regular trading session. Here is your after hours. They're up an additional 11% in the after hours. So looking very good, the stock trading in around the $66 mark right now, but still considerably down off the all-time highs. So is TradeDesk a buy right here? Let's dive into some of their earnings, shall we? So let's have a look. Here's what the CEO had to say. We delivered strong results in the first quarter, growing revenue 25% year over year to $616 million. We're encouraged by the early impact of the strategic updates at the company we implemented in Q4. Talking about the Kokai rollout, which is the name of their ad tech platform, which contributed to our outperformance. As we build on this momentum, we're optimistic about our ability to continue to outpace the market and deliver increasing value to marketers who prioritize objective, transparent, and data-driven media buying on the open internet. The outlook here, TradeDesk expects the second quarter revenue to be more than $682 million versus the street estimate of $685. So coming in slightly under the estimate for Q2, but very nice to see them growing double-digit numbers in revenue over 25% year over year. That is very positive. And the positivity does not stop there. In order to better understand TradeDesk, guys, we have to take a deep dive because we know that all of the uncertainty around the stock was surrounding that the new ad tech platform rollout. We're going to go through this earnings call real quick here, guys. And I know, bear with me. Sometimes you guys think it's boring, but if you really want to understand this company, I've highlighted the most important aspects of the call. I actually listened to the call because this was important because I'm thinking of maybe buying the stock. This is why I'm uploading the video so late. I actually listened to the Shopify one and the TradeDesk one in full. So because our technology buys one impression at a time and evaluates every single impression, we can quickly adjust. Oh, sorry. The context of this is responding to the macro. How's the macro going to be? Because we know in an economic contraction, sometimes advertisers are willing to spend less. But what TradeDesk does essentially is they are a matching service. They match ad buyers with ad sellers. So TradeDesk doesn't actually do any ad campaigns themselves. They're just a wholesale market maker, right? They match the ad buyer with the ad seller. And when you're an advertiser, you obviously want to have the best ad placement for the cheapest cost. So it stands to argue if macro gets tough, you're looking for optimization. You're not necessarily going to pull ads. You're just going to make your ads more efficient. And that's what TradeDesk does best. So because our technology, we already read that, buys one impression at a time and evaluates every single impression, we can adjust quickly. We can also be more data-driven than other forms of advertising. In an environment when CMOs and CFOs, chief marketing officers and chief financial officers, are trying to do more with less, right, the macro, we can provide them with the tools and results that they're looking for. Most CMOs and most CFOs are planning for a range of macro scenarios, and we're often a trusted partner in helping them strategize. When the large brands are facing comparatively tough times, we are focused on grabbing land. In macro environments with headwinds, such as today, our short-term success is better measured in how much land we grab, talking about market share. In this environment, we want to win market share from our competitors. We did the same thing during the pandemic. While consumers stayed home to be safe, they also accelerated their move to streaming. We adjusted our business to work from home, and we grabbed market share. In other words, we won share from everybody. His headwinds for them have traditionally been a good thing. So that is their view on the macro. Apparently, they will be able to continuously grab market share. Now, here's what they had to say about the rollout of their Kokai platform, but also a new platform that they just bought for about over $1 billion. Another massive upgrade we have made to improve the supply chain was the acquisition of Sincera. Most outside of ad tech don't know the company, and I didn't know it either. So for the uninitiated, Sincera is a metadata company that crawls the internet looking for insights about the supply chain of advertising and seeks to shine a light of transparency on that supply chain. Following the acquisition, we have been working to embed Sincera data across Kokai so our clients can have as much data and signal as much possible about their ad performance. It's all about those metrics. In the coming months, we plan to relaunch the product for the ad tech community and offer a new version of Sincera called Open Sincera, so offering it to clients for free, essentially bundling it up. This product will be free to advertisers, to agencies, to ad tech companies, to sellers, and to publishers who want to better understand the supply chain and how to make it more efficient. That's what advertisers want, by the way, guys. Let's talk now about our progress on Kokai. The core of Kokai has been delivered, finally, and adoption is now ahead of schedule. Good, very good. Around 2 to 3 of our clients are now using it, and the bulk of the spend in our platform is now running through Kokai. That is what we want to hear as potential investors in TradeDesk, because those were the concerns from last quarter, which caused the stock to drop so much. We expect all clients to be using it by the end of the year. One thing about Kokai that I would like to underline, whenever we go through a platform overhaul like this, and this is the biggest in our history, we're also trying to balance giving clients exactly what they want versus pushing the industry forward. We're in a tremendously privileged position of being the largest platform pointed at the open internet, looking across roughly 17 million ad opportunities per second. That is insane. I am confident that by the end of this year, we will reflect on Kokai as the most powerful buying platform in the industry, that the industry has ever seen, precisely because it combines client needs with the strong point of view on where value is shifting and how to deliver the most efficient return on ad spend. That is what I wanted to hear in the earnings call, guys. Phenomenal earnings call from the company, really dispelling any of those fears and concerns that people might have had coming into this quarter overall. Now, in terms of their slides here, we can take a look at some of the numbers for TradeDesk overall. Robust revenue growth, as you can see, that has never been a problem for the company overall. Ever since going public in 2016, solid revenue growth over time and with substantial profitability now too. Non-GAAP net income now coming in at $165 million for the quarter, and adjusted EBITDA has never been a problem for the company either. Let's move into some more of their earnings slides, shall we? So the TradeDesk guys, so for what you guys, if you guys don't know what they do, they provide a platform for ad buyers. Let me make it really simple, yeah? Let's say I have a business selling, tires or whatnot, right? And I want to run ads, but I don't know where to run them, where would be the most efficient. That's when I go to TradeDesk. They will tell me with their platform, where will my ad dollars be best utilized? Will it be on the Google platform? Will it be on Netflix? Will it be on Facebook? Will it be anywhere? Will it be anywhere on the internet, right? They will tell me. Should it be more on mobile? Should it be more on browser search? Where should it be? What device? And who should be the best person that I go to for putting my ads on their platform? They're a matchmaking service for advertisers between ad buyers and ad sellers, or the location of which you can sell or which you can place ads on, right? So TradeDesk by the numbers. As you can see here, gross spend on the platform here in millions, up 25%, very good. And the revenue adjusting as well at a 26% clip year over year. Looking very, very, very strong, guys, for the numbers. TradeDesk numbers have always been big. The open internet is a $935 billion market and getting bigger. So this is their total addressable market. Anywhere from social media to search to traditional media, because they also do ad placement for TV. Then we have video, audio, display, and other. And moving on further in terms of the rest of their market players here, you can see with hundreds of different players. Guys, they manage absolutely everything. And you can see they have presence on all of the ad exchanges, including AppLovin, which we covered just yesterday, as a matter of fact, with all the publishers, with all the agencies, and all the different service providers overall. Moving on further, they diversified across all major verticals overall. 2024 spend by industry, you can see that most ads are spent on food and drink, and they give a nice breakdown of everything else, and they cater to every single one of those segments overall. And they have also a strong presence globally, which is very good. And we say we buy the whole internet. Even media that isn't digital will be transacted digitally using the internet. So of course, targeting the more, classic ways of viewing ads, which would be on a TV screen overall or through streaming services, whatnot. Moving on further. TradeDesk once again reiterating that they are the go-to solution right here. Our platform approach wins more of the budget, 40% of the budget to be exact. So really beating out the competition in terms of that. They are the one-stop shop for getting the most efficient ads out of everything right there. Now, in terms of TradeDesk by the numbers, because we have to go through that. Let's move down a bit further here. Where is it? I mean, these companies do so many slides. We already saw those slides. Let's move on a bit further. Oh, apologies, guys. I thought there were more, but apparently we are done. So essentially, I'll go over the numbers myself, right? We're going to go over the numbers and see if this is a good business to buy right now in around the $65 mark. So moving on into the valuation here, guys, at $65, where are they trading? Well, they are trading at a forward multiple of 37.14. They are growing EPS at 21% per year, and revenue is very healthy as well. That gives them a PEG ratio of 1.77. Anything under 1 is cheap. Anything between 1 and 2 is okay, but you'd like to be closer to 1, and anything above 2 starts to get a little bit expensive. Forward price to sales is 10.43. They are a technology company, software as a service essentially, right? So they do benefit from a higher price to sales, and that around 10 to 15 is what your TradeDesk usually trades at right now, and a free cash flow yield on a trailing 12-month basis of 2.1%. So the valuation objectively is not that bad, all things considered. It does lead to some upside appreciation potentially. Now, net margins of the company, as we've said, have been getting better. If we take a look at their balance sheet right here, we can see that debt has never been a problem for the company overall. They have a lot of cash on the balance sheet, decent free cash flow per year, and no debt. In terms of their margins, we can see their margins have always been very high in terms of the gross profit margins. 80%, which is very, very strong. Operating margins are now rising into the mid 20% range, and their net margins as well have been fairly good over the last few quarters. This one as well, Q1 came in at 26.7% net income. So that is what you want to see, guys. Strong gross margins and bringing a lot of that money to the bottom line. 26.7% net income to be exact. In terms of their future growth prospects, they look quite good. EPS stable up and to the right, which is what you want to see for any company, and revenue as well, steady up and to the right. So if we were to take this $4.67 billion in terms of global revenue, right? If we take a 4.67 in 2028 times their right now price to sales, if you were to take price to sales on a constant factor, well, you'd be looking at a total market cap of $46.7 billion. They're trading right now at 29.72. Divided by 29.7, you're looking at an upside of roughly 57%. So from roughly here, you're looking at a recapture of roughly back above $100. But if the multiple is somehow allowed to expand, then we can do something like this, right? Times 15 price to sales, you're looking at $69 billion market cap. And when you divide that by their current market cap of 29.7, that'll be an upside of right over 100%, right? About 2.32 is 132% overall. So you would be looking at back to the all-time highs. This is for some time by 2028. As you can see, they ran far ahead of their valuation, as companies can often do, but that is giving you the target range. So there is some very decent upside in TradeDesk. Their platform is now back and better than ever, apparently, and more efficient than ever, of course, as well. So TradeDesk can be a very decent candidate for a buy here, in my humble opinion. And if we were to see any further declines, the buy area gets even better. Those are the numbers. I would heavily consider this one, and you may just see it in one of my accounts in the near-term future. That's everything for TradeDesk. Now, let's move into company number 3, which is going to be another very hot stock in the name of Cloudflare. So Cloudflare obviously operating in a very hot segment of the market right now, which is cybersecurity, right? Now, the company has been down after tariffs. Right now, they're currently sitting around 29% down. However, they did have a very good quarter and a very decent showing overall. The company right now up in the after hours, roughly around 8%, as investors were largely pleased with their earnings. Let's take a look at some of the numbers right here. EPS, ever so slight miss here on EPS by 2.23%, but they did have a nice beat on revenue by 2.09%. Now, Cloudflare has been a company that, like many other companies in the cybersecurity space, they are at the scaling phase of the business. So net margins have been net negative ever since the company has been public, but they're getting less and less negative overall, eventually trying to scale into profitability. Now, not many companies in this segment are profitable. Fortinet is the first one coming to mind. That is the most profitable cybersecurity company on the street right now, coming in with net margins of in the high 28% range. You can even check companies like CrowdStrike. CrowdStrike arguably is still not consistently net margin profitable, and even a very large company as well, such as Palo Alto Networks, is additionally profitable, but not the highest margins compared to Fortinet. However, they are bringing in double-digit profitability metrics, and this company too started off as a non-profitable entity and eventually grew into profitability. So the entire focus around Cloudflare is, can they scale into profitability? And the answer, as we will soon see, is yes, indeed. Let's move into those numbers, shall we? So in terms of Cloudflare, very good revenue year over year, guys. 27% bump year over year on revenue. They have 27% higher customer count as well, looking very good. Operating income up 32% year over year, and their EPS unfortunately was roughly flat as they still try to scale into that profitability and bring more money to those bottom line earnings. You can see here that operating margin is a bit of a topsy-turvy curve, but when I show you the gross profit margins of the company, you'll understand that they're starting off from a very high point, such as most of all these cybersecurity companies are starting off with 76% gross margin. So now it's just a question of scaling the operation, scaling revenue, so that your operating expenses eventually become a smaller and smaller portion of your revenue. And then eventually that is how you achieve profitability. Many different companies, especially in software, go through this exact same landscape. Let's move into the earnings, shall we? So in terms of the comments from the CEO, we kicked off 2025 with confidence, momentum, and strong results. In Q1, we landed the largest contract in Cloudflare's history, a more than $100 million deal driven by our Workers development platform. And overall, we have the scale, the technology, and the team to capture the massive opportunity ahead of us, as evidenced by the size and length of the deals we're closing and the caliber of customers betting on Cloudflare. In a constantly changing world, one thing's certain: innovation wins. From networking to security to AI, Cloudflare is the envy of the industry for innovation, and there is no slowing down. Now, I will have to admit that Cloudflare is one of my favorite companies in cybersecurity. My favorite one, guys, are pretty much the ones we went over: Cloudflare, Fortinet, CrowdStrike, and Palo Alto Networks. Now, some of these companies do have overlapping offers overall, but I digress. Let's move into some of the earnings slides, shall we? So Cloudflare at a glance, you can see revenue, fantastic revenue growth, 31% compound annual growth rate over the last 3 years overall, 250,000 paying revenues, and getting larger and larger customers overall. Large customers, you can see now with over $100,000 in annualized revenue, represent 69% of overall revenue. Very strong overall. Now, it will save you pretty much from exactly the services that they offer, because it is quite complex, but you can just see that they do 3 different things: network and security, applications, and store and compute. These are some of their major clients overall, right? Cloudflare, a lot of people run through this. You guys want to see something funny? When you go through Cloudflare, they run their own stuff on their website. Cloudflare earnings. When I go here and I click on this website right here, this is a little funny little tidbit, right? And when you go through investor relations here, I don't know if it's going to do it this time because I just went through it. It's not going to do it this time, but it goes through the whole Cloudflare verification, verifying your IP address, verifying that you're human. You guys have seen that before when you go onto a website, right? So these are some of their major partners overall. You can see that if we go down into some of their earnings slides here, 330 plus cities in 125 countries, including mainland China. And they're saying that across everything, 95% of the world's internet connected population is within 50 milliseconds of a Cloudflare data center. So a lot of different companies, guys, are using their services overall to securitize their websites and many other different things. Now, moving on further, you can obviously see that they have a very large total addressable market across their various different services, whether those are Cloudflare developer services, this segment in blue right there, in terms of their Cloudflare network services, which provide security for the network, of course, very large growing segment of the business as well. And then their Cloudflare Zero Trust services, in which they provide VPN, content filtering, remote browser isolation, data loss prevention, so on and so forth. As I said, many of these cybersecurity companies have somewhat overlapping offers, but as you can see, they are broadening out the company overall. They used to only do this, and now they're broadening out their services overall. So I do really think that they'll be able to scale all lines of business through these various different things, especially with more and more people moving to the cloud, more and more people moving online, more and more AI. That means more and more revenue for Cloudflare as well. In terms of the financial overview, you can see that the overall gross margins are pretty good right here at 77% gross margins, as we saw when I took you through those statistics in the trading view as well. Revenue we already covered overall, but nice to see them go there. Rapid customer growth, paying customers has been steadily increasing, guys. 100,000 more customers than they had at this same time period in 2022. And even their large customers, guys, looking very good, from 1,500 to 3,500. And most of those are, well, those customers are now representing a larger and larger portion of that revenue. So it just goes to show they can go and get very, very, very big customers overall. Strong dollar-based net retention overall, 111%, which means that not only do people stay on the platform, but when they do stay, they start to get more and more services. That's why your retention rate is over 111%, right? Or rather over 100%. And as we saw, non-GAAP gross margins are fairly good, although off the highs of 80%, 76, 77% is roughly industry standard. Some are above 80, some are in the mid 70s, but overall very good. In terms of the cost, talking about scaling into profitability, are they able to do it? Well, here we go. Here's the leverage in their operating margin, the non-GAAP operating expenses as a percentage of revenue. This is the same thing we just looked at on Shopify as well, right? Very important. Cost of goods sold, that is stable, maintained. That is basically revenue minus cost of goods sold. That gives you your gross profit margins. You remember that we were saying that it was about 78%, 77%? Well, there it is, right? The inverse of 1 minus that is about 22, 21%. I digress. Sales and marketing, S&M, right? That has been coming down and down and down. Now, Cloudflare doesn't have to do as much sales and marketing as they attract larger and larger customers and retain those customers. R&D, now that the platform has roughly been optimized and that they've really gone into several different markets and expanded their product services, well, you can see that R&D is becoming a lower and lower percentage of revenue overall. G&A as well is becoming a lower and lower percentage of revenue. So it's nice to see that while they are scaling revenue, they are not also ballooning expenses, or these numbers would be the same. If a company grows revenue by 30% per year, but increases expenses year over year by 30% as well, well, these numbers would stay flat. That's not what we're seeing here. Their revenue growth is outpacing the growth of their expenses, which is why you can say that they're doing a good job of trying to get more operating leverage overall. We can see a strong cash position for the company overall as well. $1.9 billion in cash balance. And in terms of the guidance, they're expecting a revenue range of roughly around $2.09 billion. That was the exact estimate from analysts. So no beat on the end of the year guidance there. And overall, we can see that the Q2 as well is roughly in line. I mean, you don't see the estimates here, just take my word for it. I double checked all these numbers. Roughly in line. So maybe one of the reasons that the company didn't get a crazy beat in the after hours was because that their guidance came in roughly in line. But in this macro environment, that is a good thing overall. And here you can see their long-term run rate model for those costs. You can see here gross margins they're charting roughly where they are right now, 75 to 77%. In terms of their sales and marketing, right now it's at 38%. They want to bring it down another 10% as a percentage of revenue. R&D, that's going to be slightly higher. They want to keep it to 18, 20% to always be, I guess, on top of the best tools in the market. G&A should be coming down from 11 to long-term target of 8 to 10 overall, which gives you an operating margin long-term of 20%. Right now it's at 12. And what does that mean for net margins? I wrote a question mark right here. Does that maybe mean 10%? Final net margins? That would be pretty good. That would be roughly in line with what a company like Palo Alto is doing right now, or the long-term projections of a company like CrowdStrike as well. 10% net margins is pretty good overall. So Cloudflare right now at a value in the after hours of $135. I will circle it right around here. Is it a good buy? Well, it all depends how much you're willing to pay, right, for this growth. They're growing revenue and EPS at a very steady clip right here. We know it's not a profitable company, but that doesn't mean that they have a tremendous amount of debt. You can see they do have some debt right here. It's not that much, all things considered. They do bring in roughly, anywhere between 1.6 to in the future $2 billion per year. So not a crazy level of debt, although they do still have some on the balance sheet here. Expansion for EPS is looking pretty good here over the next few years. finally ramping EPS in an exponential fashion after coming from negative to positive. Now this is the true ramp and scale phase of the business, and revenue, as we can see, steady up and to the right, guys. This is really going to be a fun thing in time for the company in the future. So their revenue right here is about $3.8 billion in 2028. Keep that in mind when I run through the numbers right here. At 135 currently, forward price to earnings 169. Divide that by their EPS, which is very strong. You get a PEG ratio of 5.11. It's very high. But all of these companies, guys, whenever I do these cybersecurity companies, they all trade at very, very rich valuations because they're all growing at extremely rapid clips, all things combined. So EPS might not be the best metric for a company that's just coming into scale and profitability right now. Price to sales for the industry is also very high, one of the highest industries in the entire market right now. You can see there, price to sales of 20.47. So if we were to just take a flatline price to sales, if Wall Street continues to allow these cybersecurity companies for the next 3-4 years to trade at a 20 times price to sales multiple, what does that mean? Well, you remember their 2028 revenue of $3.85 billion. That means if we keep that as a constant, you're looking at a $77 billion market cap by 2028. The company right now is $43 billion. So this divided by that gives you 80% upside potentially in the stock. 80% upside in the stock from here by 2028 at some point in time is all the way, well, it goes even higher than the chart, guys. You're looking at approximately a valuation right here of about $238 overall. So the company might just have a 2x left in it still, but of course you do want to get the best possible price in the event that the company comes down a little bit more. Now that you know what the allowable multiple can be, it's a range though. You could do this with 10 or 15 or 20 for bear, medium, and bull case scenario. I think 20 is the top end of the price to sales range, if you ask me. If we can find Cloudflare somehow again back in the $100 range, well, then obviously your ROI, compound annual growth rate, will get much better depending on those bear, medium, and bull case scenarios. So that is my thoughts on Cloudflare. Very strong company, a lot of growth left in the tank for this one overall, but does trade at very rich multiples. So you do have to be a little bit cautious and try to get the best possible price overall for this fantastic company. That is everything I had for you guys for today's earnings. Hopefully you enjoyed them. Now let's dive into some charts, shall we? All right, so taking a look at the SPY right now, up about 0.7%. We know that who's been in control of this chart, guys? Well, definitely the bulls, right? So keep in mind, we are now still in the context of a beautiful daily uptrend on the SPY. Our higher low is set right now at the low of yesterday, 556. We hit a new high, but then gave back a little bit of the gains. We are still trading above that 200-day EMA, and this whole area is support, 565 to 552. The bulls have been building a little bit of a shelf overall. It's curious to see whether we get that expansion into the high end of the range. Trade deals, or trade talks rather, with China will be front and center over the course of the day tomorrow and into the weekend as well. 585 to 575 is the top end of the next range of resistance. In the event that you lose this without setting any excessive more highs, unfortunately, that would be the start of a daily downtrend, and you'd be looking for weekly consolidation at this point, anything above 509, looking for a weekly higher low for possible further trend continuation. So keep that in mind, guys. Maybe if we do get some negative macro headlines in terms of some hard data erosion over the next 2 weeks, that might be a catalyst to propulse the markets into a consolidation phase. But remember, the bulls still have a lot of space to work with here. As I said, anything above 507, looking for a weekly higher low. So if we start to unravel here, don't panic. There will be more trade opportunities when we approach the bottom end of that range into the next line of defense down here at around 530. And I'll be patiently waiting for those deals if they do come through. Onto the Qs right now, up 1.03, and a new leg of the daily uptrend has been set in motion. Higher lows are set at the highs of yesterday, 476. And although we did break above, we did not close above, right? That being said, we are coming into resistance quickly, 493 up to 509. It is this entire top area of the Qs. We are right now above the 200-day EMA. If the bullishness continues, you can expect the bulls to move into the resistance zone a little bit. But if we unravel from here and flush yesterday's low, you need to understand it's the start of daily consolidation. Daily downtrend into support 480 down to 464. It's nice that we have a lot of moving averages below us and a support level. It'll provide some short-term defensive area for the bulls, but if ever that is not enough and we roll over with some hard macro data erosion, you might just be looking for a weekly higher low at this point, anything above 427. Weekly higher low for maybe some further trend continuation. Pull back too much, you might end up in some awkward tightening range, right? But we are right now in the context of weekly uptrends. I'm just not in the business of chasing the market too much at these higher levels. I'll be patient and wait for the deals to come to me. On to the XLF right now. XLF as well, a new leg of the daily uptrend in motion, clear as day, right? Daily uptrend, higher lows are set with the lows of 2 days ago, 48.9, and now looking maybe to move into the resistance range, which is 50 up to roughly 51.5. I mean, you can extend this a little bit more. You can encapsulate the entire highs, but truly the range is right there. All you need to understand is that resistance is coming sooner than later. Overall, guys, if we are not able to make much more highs than this, and we flush the lows and roll over, we got a lot of support below us, 48.31 down to 46.81, and that would just be looking for a weekly higher low, because as with the SPY and the QQQs, this is a beautiful weekly uptrend, 3 weeks of up in a row. Eventually, you will get a pullback here. Just understand that there's a big support below us, and anything above 45.15, looking for a higher low for possible further trend continuation, and that's where I would be sitting to look at some of the major banks and the credit card players as well. If there's any deals, I'll definitely let you guys know, but as of right now, financials just a little bit trading high for me right now. I'm going to be waiting for more extended consolidation. On to healthcare, which has been the most lagging sector of the entire market so far. Daily downtrend simply continues at this current stage. The weekly is just trapped in some awkward trading range, somewhat between 139 all the way down here to 131. So we'll let the bulls and the bears do their thing and battle it out, because we know it's a heavy range of consolidation. This is the entire range from 2021 through 2023. They're battling around the 200 weekly EMA, which has historically been a good criteria for buying some of your favorite healthcare names, right? Names like Eli Lilly, which have consolidated a lot from the tops at the lows of roughly almost a 1 year range of accumulation. Names like UNH that are also at the bottom end of a now 4-year price range and trading at fantastic fundamental valuations overall, and other companies like that. That is a sector that you may want to target if healthcare is something that you do indeed like, as now we are just in a heavy phase of weekly consolidation. The one level you do not want to break is this 130, because if you do break that, guys, weekly downtrend resumes, and then it just takes a whole bunch more time for healthcare to recover. Healthcare usually moves slow, so any buys made on healthcare need to be made with some patience in mind. Moving on to SMH right now, semiconductors benefiting from a nice little extra leg of up today, breaking into a new high, so we know this one as well is a nice daily uptrend right there. Overall, guys, sorry, I gotta make this chart more flat. So overall, the higher lows are set at the lows of 2 days ago, 213. So pay attention, right? As we move into the support resistance range, 232 down to 214. If we cannot get it done and we roll over, breach these lows, and set the daily downtrend, all is not lost. I know that it'll be a weekly rejection from a very big weekly resistance range, but who's in control of the weeklies here? It's the bulls. Weekly option, and there's a lot of space above the lows. Anything above 184, looking for a higher low for further trend continuation. And that is what I'll be waiting for to position, again, a bit heavier in some of my favorite semiconductor names when they pull back, either looking for swing trades or writing short puts well under the market. But semiconductors for now, looking pretty good, all things considered. We will let the bulls battle it out and then keep an eye for that weekly pullback where we might be able to see some better entry opportunities. On to the Russell right now. The Russell doing pretty good today, 1.9%, also establishing a new daily high. So the daily uptrend on this one has been clear as day for the past couple of weeks right now, and today is no different. We will see. Can I close this box green? And I'll only close it green if they meaningfully close above this resistance range, which is the big one, 200 down to 188. It's been a big area of congestion for both bulls and bears alike. A long time, right? Now looking pretty good. So in the event that we don't get it done, right, and we just roll over and breach the high of low of yesterday, 196 roughly, you breach that and you lose the daily downtrend. Well, what's going to happen, guys, is you're looking for a weekly higher low, similar to everything else, anything above 180, looking for a weekly higher low for possible further trend continuation overall. Essentially what I'm saying on all these sectors, guys, is that we've had very nice rallies in the last 3 weeks, but don't have any FOMO. Be patient. Let the market come to you. We know that the hard data is possibly coming. The market is in limbo mode right now, right? In pure limbo mode. We had good earnings in Q1, and the data from the economy is still somewhat good. But everybody thinks that the data will erode into the future, and that might be coming in the months of May, like right now, in the mid-month of May, into possibly June. So if we see several weeks of consolidation, don't say that I didn't warn you, right? I'm not trying to predict the market. I'm just telling everybody to exercise some patience, and that now might not be the best time to deploy full cash into the market, full FOMO, when we still have a lot of tariff uncertainty ahead of us, right? And a lot of macro data uncertainty as well. So holding a bit of cash is fine. In terms of trading, you should be patient, should be trading with a stop loss as well, and waiting for the market to come into your levels rather than chasing. And for a long-term portfolio, it's always been so clear, guys. Every single paycheck, 10-15% of your paycheck should be put into your favorite companies, statistically proven that just DCing over time wins the race in the long run. If you want to hold 10 to 20% cash back, no problem at all, but I wouldn't really be holding much more than that. Moving on to the Dow Jones right now. Dow Jones up 0.62%, also setting a new, leg of a daily uptrend in motion, now clearing the box of resistance. We'll see. Can we close it above? I'll be able to close that box green. If we don't, I won't, right? Daily uptrend is nice. Anything above the highs of 2 days ago, 40,007, looking for a higher low for possible further trend continuation. To the downside, however, we have to keep in mind that if we lose this and go into a daily downtrend with some negative news headlines, XYZ, right? Well, at that point, you're going to be looking for a weekly higher low on the Dow, anything above 37.8, looking for a higher low, maybe for a second continuation at this weekly uptrend overall. And if we just blast through this area right there, just understand that the next line of defense for the bears is all the way up here, 41.9 up to roughly 42.500. That's pretty much everything for our major sector rundown. In terms of the VIX. The VIX down at a low, 4.55, right, to the downside, 22 on the VIX. Now, we know that current market conditions can warrant a higher for longer VIX, as we saw in 2022, as we saw during the pandemic, as we saw during tariff episode number 1 during 2018, the election campaign in 2016, and of course, the flash crash in 2011 and the great financial crisis. So I'm not ruling out that the VIX is just going to pop up eventually, right? You can't say that. You can't say we're just going into an environment where everything is perfect in the markets and there's no concerns whatsoever. So be very careful with this one. When the VIX has come down so much and the last 3 weeks in the market have been so good, it just takes one little spark to ignite that flame of uncertainty, and you could be seeing a rally in the VIX. So be careful, right? When the VIX has been coming down after so long and you know there's still a lot of uncertainty, just be careful in your trades, guys. Be very careful because you can end up with a nasty VIX surprise eventually. Now, moving on to the dollar recapturing the $100 level. Now, today was pretty good, guys. Today was a good day of dollar performance. We've been noticing that this one has been fairly weak. The reason we track the dollar now is this is foreign investment back into the United States. Now, what today did is it provided the framework for some deals that the U.S. is ready to negotiate and may just attract the interest of other nations looking to negotiate some deals as well. The administration has told us that there is a lot of negotiations underway right now, but maybe now people will be trying to negotiate in a more accelerated fashion to get the best possible terms. And that has established a little bit of comeback into the dollar overall, which is what you are looking to see in terms of people's trust in the dollar and flocking back to U.S. assets. Another thing that might have helped this is Jerome Powell being very firm on the stance of interest rates yesterday. The Bank of England dropped rates today as well. And most of the rest of the world are now under, in terms of the central banking rates of most of the rest of developed nations, at least, are now below the interest rate that the U.S. is paying on their treasuries. So people might be coming back into dollars to maybe buy bonds because they offer the highest yields, all things considered. But this trend may still be on the table. We'll keep a close watch for that. Speaking about yields were also on the drop, or rather, yields were on the rise today, as a matter of fact. This one is just such a tricky trade overall here, guys. They go up, they go down, left, right, and center. You got some bond trader speculation here. You got global money movements in or out from the dollar, global money movements in or out of bonds. This one's going to be a very complex trade, guys. It serves no purpose looking at this on a daily basis. All you need to see is, are we going to be in a weekly uptrend or a weekly downtrend? That still remains to be seen. Yields are still somewhat high. We know that we have a Fed put up here at the 10-year 4.5 and the 20-year 5%. So if we do come up there, expect there to be more talks from the Fed, most of which we're getting tomorrow. A lot of Fed speakers tomorrow, right? So we'll see if that has any impacts on yields. And TLT just doing a whole lot of nothing overall here, guys. I still think it's a good trade, but as I've been saying many times, you have to be very patient with this one, guys. Very, very patient. Rates will be coming down eventually, but we're talking about late 2025 into 2026. So now's the time to be building positions, but don't expect some very quick profits on this trade overall. That's everything for that. Gold coming down as well. As we've seen a pushback in the dollar, and gold is an expression of the dollar overall. So what was tried to be is an attempt from the bulls right here. Daily downtrend, engulfing move, looking for a higher low, using these guys as support to maybe go for some continuation. Well, that trade deal maybe took people out of gold and maybe into some more risk on assets such as equities. Maybe. There's many factors at play here. We know central banks have been accumulating the heck out of gold, not just this year, but for the past 5, 6, 7 years overall. But right now, taking back a lot of that move overall. So in the event that that is a lower high, the higher time frame provides more clarity, right? Weekly uptrend, nice high, higher low, higher high, or lower high, excuse me. If you start breaching these lows, that is weekly downtrend and synonymous with monthly consolidation. If that eventually happens on gold, which would not be surprising, it always does, weekly first stop is 3,100 and the monthly 12 EMA is all the way down here at 28. I'm not calling for it to go down there, but eventually gold does like to consolidate on the monthlies. So maybe we might be seeing an episode of that. If you start to see more trade deals, it would not be surprising to see gold take a little bit of a breather, but this one still overall is in a big uptrend. Moving on to Bitcoin now. Bitcoin, super solid on Bitcoin, guys. What a day for crypto, 6% to the upside. The risk on sentiment was definitely felt in crypto. Bitcoin with a 6% day, and Ethereum finally doing something, 22% day on Ethereum, clearing a big level. Let's talk about Bitcoin first. So, we always knew that Bitcoin was in a daily uptrend, right? Higher lows were set right there at about 93, which is what I was saying. And I was saying there is a swing trade right here for a possible long. It was looking good even on the weekly here, guys, but a hesitation around there. Bull flag on the daily for the most part, and then pop. And where do we pop into? The exact line of defense that I was talking about, 100,000 to 105. We are now sufficiently above the 100% $100,000 mark. And weekly MACD is still crossing to the upside. That doesn't mean that we have to do this. We can do this, pull back and set a higher low, and then go for the expansion, right? At this point, anything above 75 on the weekly, looking for a higher low for further trend continuation. Same thing on the daily, right? If this move pulls back, a lot of space for the bulls, anything above 93.5, looking for a healthy retracement for possible extra longs in play, or just mount above. That's another option. Mount above, breakout, retest, and run is another trade opportunity. I like Bitcoin. I've been holding Bitcoins in my long-term portfolio for a very long time at this point, both on chain and in the form of ETFs. And it's looking very good. I think it's a very strong thing to be holding over the next 5+ years overall. I'll continue to hold. And if Bitcoin continues pushing like this, you can see a continued resurgence into altcoins. Many altcoins coming off their lows. Ethereum still looking for a new weekly uptrend. The next target for them, probably up here, 2,200. And then the big one, of course, 28 to 3,000, but looking very good. It was a nice area to be accumulating. As I was saying several times on the channel over the last 2 months, it's a slow accumulation period. So maybe some of you guys accumulated some ETH. Now it's good, but now we got to kind of let it do its thing as the overall crypto space gets some renewed interest with that risk on sentiment. But everything can be unwound with hard data erosion in the market. So always keep that in mind. It's a long duration trade for the risk on recapture. That's everything for your overall market rundown. Now let's move into big tech. All right, so moving into Apple. Apple up about 0.63% today, erasing some of yesterday's losses and trying to set up some daily higher lows right here. So we had the daily uptrend underway. We knew the higher lows right here at about 189.35. Remains to be seen. Can they use this support area as a backstop, 196.20 down to 188, and try to get a little bit of a daily push underway? Well, there might be a little bit of a swing trade right here. The trade would go as follows, right? The entry is pretty much right now. The stop loss would go below your daily higher low, possibly below the entire support range overall, and you would be targeting these range highs into resistance, about 210 up to 222. Not too bad of a trade opportunity, but Apple has been somewhat sideways and dealing with a lot of news catalysts and trade restrictions and everything in between. The weekly is not so clear. They tried to go for the weekly uptrend, got rejected at resistance, and now we're right back down here. So we may just be in for some form of a consolidation range with bounces between the tops and the bottoms, as Apple still continues to deal with several struggles in its AI department, and of course, $900 million in tariffs per quarter with an unpredictable Q2, as we saw in their earnings just a few short weeks ago. On to AMD right now. Nice to see them up today, 1.34% to the upside. But as you can see, they were up 3+, then gave back a lot of the gains. That being said, they are right now in a nice daily uptrend. The higher lows are set with the lows of yesterday, $97. Now, this has been one of the first times in a long time that AMD has been above its short-term and 50-day moving averages. The last time they did that was there, and then we got unwound with Liberation Day, of course. Can they do it again? I mean, it's been a long time, guys, since October that we haven't done that, right? So that is notable to us as well. We'll see if they can push through. If they can keep pushing through, keep in mind the top end of this resistance range is 112 all the way down to 98. If we give it all back and go into a daily downtrend, which at this point would not be surprising. That would be if the SPY and QQQ go down, because AMD earnings, we covered them just the other day, and they were quite good, right? Keep in mind, it is a weekly uptrend right now, so any pullbacks on the daily would be looking for a weekly higher low, anything above 83, looking for a higher low for further trend continuation. I like the company's fundamentals right now. It does lead to a lot of upside appreciation, maybe in the next few years, and we also have a nice weekly cross on the MACD. So even if we pull back, maybe we're due for a little bit more upside overall. Any chip news is going to do this company wonders, of course. If you didn't check out their earnings, make sure you do. It was on the Tuesday video. On to Amazon right now. Amazon up 1.79%. My favorite company, arguably, of all of big tech right now. Amazon looking very good, going for the daily uptrend break higher. And at any point, if we do pull back, looking for a higher low, anything above 184.29, higher low, maybe for some trend continuation, that's whenever they choose to pull back, right? If we have another green day, well, that same pullback is going to be the case. Would be one of the better case scenarios for Amazon. Give me a clean break above this entire resistance range, which right now is 191 to 180. It's been problematic for the bulls for a long time, and even all the way back there. 190, there's just something about 190. You would think that's 200, right? There's not much at 200 other than these guys, right? It's all about 190. If we can get a clean break, I'll gladly turn this into a support box. And then you'd be looking for one of my favorite trades, the good old weekly uptrend breakout, retest, and maybe run. That could be a very juicy trade opportunity, but Amazon remains at a very fair valuation overall, in my humble opinion, for their present growth prospects. So for a long-term portfolio, it is indeed a buy opportunity, in my opinion. And any declines here, looking for a higher low above 165, would definitely be an opportunity as well for a swing trade. So one of two things, either a higher low for a swing trade, or the breakout retest for a possible swing trade as well. On to Google right now. Google up 1.93%, erasing some of yesterday's losses, but this is a big candle, man. Overall, though, daily downtrend is clear, so you would be expecting any moves higher, looking for a lower high, for a lower low potentially, or an equal low. The Bulls definitely need to play defense down there. The Bears are in short-term control. That being said, right now we are above a big area of support, 150 down to 135. The valuation on Google right now is excessively cheap because they're facing a lot of problems. Increased competition from AI for their search business and a few lawsuits as well. That being said, I still think the valuation of this company alone does deserve a bid in of itself. But overall now, we have lost a lot of that weekly momentum. It was a weekly uptrend. We've came down equal highs. Now, as Google moves through all of its concerns, we may just be trapped, guys, between 163 and 175 and the lower end of support. So when that's the case, I want to be writing puts on this company down below here. That's my preferred way of playing this stock in this type of market. On to Meta right now. So Meta up 0.2%. Very small day on Meta, but they gave it all back. They were up over 2% at one point, gave it all back, but still in the context of a nice daily uptrend. Higher lows are set with the lows of Tuesday right there at about 586. In the event you pull back, you need to set a higher low to go for the trend continuation. That's if they don't just keep blasting off from here. Same concept though, you'd be looking for a higher low. If you lose the higher low, you lose the daily uptrend, you open the door for this, right? And then you just open up the door for weekly consolidation. I cannot close this box green until they close a weekly candle above 600. 600 down to roughly 560 is this resistance range. And any pullbacks could be nice for a little buy here on Meta, looking for a higher low, anything above 481. Higher low for possible further trend continuation. So that is the style of trade that I'll be looking for on this fantastic company with very high net margins, juicy free cash flow, and a very cheap valuation in and around this current price right now. Great for a long-term portfolio as well if you have a 5 to 10 year time horizon. Moving on to Microsoft right now, up 1.11%. I mean, another very positive day for Microsoft overall. Higher lows are now set at these right there, 431. Cutting it pretty close. Daily uptrend, clear as day. Moving on to the higher highs. If Microsoft continues to push, well, the next lines of defense are 446 and then 450 flat psychological. In the event that we lose this and start coming back, you're going to lose the daily uptrend and you'll be into daily consolidation, opening up the door for a daily downtrend. And that would just be looking for weekly consolidation. On this beautiful weekly uptrend by Microsoft, so much space created by the bulls with that earnings. Anything above 357, looking for a weekly higher low for further trend continuation. So still not a considerable enough break above this high to where I can consistently say, yeah, we broke above it so much, it'll probably be support by the bulls. If you reject from here and don't close this candle like this, you might just be looking for a higher low all the way down here in the lower $400 range, which is where I would be looking for a swing trade or possibly even adding more shares to my long-term portfolio. On to Netflix right now. Netflix down about 0.95%. Finally, man, a red candle on Netflix. I didn't even think it was possible anymore, right? I'm just kidding. Higher lows are right now set at $1,107, right? The daily uptrend is gorgeous on Netflix right now, but eventually all good things come to an end. Daily MACD, you can see that rolling over. We also have some divergence here on the daily RSI versus the price, so that could indicate some further downside for Netflix as it gets a little bit of a, breather, right? It's been carrying the market so far, even though it doesn't have the tremendous weight in the SPY, but still, you guys know what I mean, right? In the event you set no new highs, and you break this low right there, that will be a daily downtrend, first in a while, and then you'd be looking for weekly consolidation. The weekly chart provides the best clarity, in my opinion. Anything above 825, looking for a higher low, maybe for some trend continuation down the line throughout the rest of the year. The area that you should be looking out for is roughly $1,050 to $1,000. That pocket right there, in line with the 12 EMA, something like this, and maybe a run. Who knows? But that is something that could be likely if ever Netflix continues catching a nice bid. Up here, it is a little bit expensive. Moving on to NVIDIA right now. NVIDIA up 0.2%. Now, unfortunately, NVIDIA at one point today was up over 1.25%, but gave a little bit of it back. But what NVIDIA is trying to do right now is they're trying to clear this resistance range, 115 down to 105. They've been stuck there and below for a very long time at this point since the month of March, battling with the 200-day EMA, which is this line right there, trying desperately to come above it. Haven't been above there since the early stages of March as well. Daily uptrend is very nice right now. The higher lows are set at 110.5. Any move lower from here, looking for higher low, maybe for trend continuation, using this area as support. If they close this weekly candle above 115, I'll gladly close that support box into a green box of support. And that would also be a weekly uptrend, right? Because now we'd be closing above the highs of this week right here, right? Early April. You can see the weekly MACD is also looking good after NVIDIA has been bearish in terms of momentum since November. Yeah, since November, they've had bearish MACD. Maybe can we see some upside? Well, definitely any news, positive news on the chips in terms of deregulation is definitely going to help this company overall. And if we do pull back from here, looking for a higher low, anything above 95, higher low for further trend continuation. There is a trade here, push higher, retest. There's a swing trade right there. Any dips here for possible longs into the next range resistance high, 135 down to 126. NVIDIA around here is still somewhat cheap. I'll redo this valuation for tomorrow's video just to understand it's still trading around a 25 forward price to earnings. They have earnings at the end of the month. On to Tesla right now. Tesla up 3.11%. Pretty good day for Tesla overall, guys, but no break of the range, right? Still no break of 295 to the upside and no break of 270. So we're really just bull flagging right here. The reason I call it a bull flag is because it's at the top end of a very powerful move after earnings. So one thing's for sure, we are in the confines of resistance, 300 down to roughly 260, a very big line of defense for the bears right there. We'll see if they can get it done. The bulls are lining up something clear right now. They're trying to go for the weekly higher lows and go for the trend change. You'll only know that's the case if they break above 295 and close a weekly candle above that. Tesla is not looking too bad overall. Not one that I'm looking for, but pay attention to this MACD. It's been bearish pretty much since the early stage of January off the all-time highs. So there might be a swing trade here, guys, but you probably should keep a relatively tight stop loss. If you're doing that swing trade for the longs, you probably should keep your stop loss below there because that would invalidate the trade. And that would just mean that the weekly higher lows are not set and you may be due for a bit more consolidation. On to Palantir right now, 7.85%. Palantir looking to recover its earnings losses right away as retail continuously buys the dip. Who can blame them? The company is doing fantastically right now. Daily uptrend is nice. Higher lows are set at the low of earnings, 105.41. They are possibly just looking for trend continuation. But if we get stopped out, there's two possible scenarios. A tightening range, which would just be a bull flag on the weekly, right? Something like this. We're looking for a weekly higher low, and then maybe trend continuation if they can't get it done in one clean shot. Or the other thing is going to be a daily downtrend, which also be looking for a weekly higher low, right? So moves are very clear. The weekly shows it best. 66.68, looking for a weekly higher low for possible further trend continuation. If we come back down there, this is a glorious entry for Palantir, in my opinion, for a swing trade purpose. And even if you're looking to build some long-term shares, the valuation is somewhat more manageable, even though even here it's expensive. I mean, it's expensive here, it's expensive here, it's expensive here. I guess if you project with a long enough timeline until 2030, you can kind of assume the price of sales makes sense. The most recent example would be like a Tesla. Tesla used to trade at like 400 price to earnings, right? And now they only trade at 100. So maybe that's going to be the next Palantir. We will see. Moving on to SoFi right now. SoFi also up today at 1.92%. Nice breakout on the daily time frame, some SoFi, right? So daily was an uptrend. We pulled back for earnings. Then we got a tightening up of a range right here, bull flag in other words. And then you have a higher high break. So a new daily uptrend has been formed. Any move lower right now, looking for a higher low. Anything above 1244, looking for a higher low for that new daily uptrend expansion. Overhead resistance stays put, $14 up to $16. And the weekly showed it best all the time, guys. This was a weekly downtrend. You got a nice weekly uptrend. You're looking for a weekly higher low for some continuation. Maybe that has now just been set. Maybe you might look for it. In the event that's not the case, and SoFi just stays range bound, you guys know the drill, right? Swing trades for me, $12 down to about $10. I love buying SoFi down there for the long-term portfolio and writing short puts under the market. And then whatever you have, you can feel free and comfortable to ride into the $14 to $16 range because that is the next big range of resistance overall. On to Uber before last. So Uber now 1.61%. Their earnings were good yesterday. We covered them on the channel. Now just looking to consolidate. The daily uptrend is very clear and it's a transition phase for the company right now in terms of just, trying to set the higher lows. So anything above 77.21, looking for a higher low, possibly for further trend continuation. If that's not the case and we lose the uptrend and go into consolidation, the support range down here is 80 down to 77. I'll remind you who is possibly going to be in control here. Nice engulfing move on the weekly, reversing this weekly downtrend, now looking for a weekly higher low for further trend continuation. Check out the earnings if you didn't on the channel. Very solid, little bit more expensive here than it was all the way down there, but objectively speaking, still not very expensive. On to TSM lastly. So TSM up 0.39% overall today. Still no break to the highs or to the lows, so they're going to be trying to continue this beautiful daily uptrend push into resistance, which is 183 up to 193. If they can't get it done and we lose this 170 mark, that is a daily downtrend, and that would be weekly consolidation. Weekly uptrend, though, looking very solid. Anything above 146, looking for a weekly higher low for further trend continuation. Look at this MACD on the bottom here, looking very good. So any moves down here, I'll be looking for some swing trades on TSM and writing some short puts under the market as fundamentals are fantastic. That is everything I had for you guys in today's video. Hopefully you enjoyed it. If you did, consider dropping a like. Would appreciate it for the growth of the channel. Consider subscribing to the channel if you're new. Would love to have you back. We do these every Monday to Friday after the close. And lastly, if you have any questions, feel free to list them down below, guys. I'll answer all questions tonight. Looking forward to see you in the comment section overall. Apologies for the late upload today, guys. Had a couple things to do. Then I had to do all the earnings prep. And here we are. It's pretty much 10 p.m. Eastern for the upload. But I got you guys always, not missing a single upload. And the next time I'll see you will be tomorrow, where we'll do a trade recap. Quick little preview. We are perfect on all trades for this week. No losses whatsoever. Very good week for us in the Discord, the link to which is down below and all the information. And that's it for me. Take care. I'll see you tomorrow's video. Wrap up the week strong, guys. Don't get too greedy and have a great day. Peace.